Why struggle through a post-merger integration when you can glide through it? Why deal with the PMI integration challenges when you can overcome them even before they occur? Why move slow when you can move at pace? What are the world's leading PMI experts doing right now to achieve profit-accelerating integrations? This podcast will give you all the answers to these questions and many more. My name is Dudley Peacock, and welcome to the 100 Days and Beyond podcast. Okay, welcome everyone to another episode of your 100 Days and Beyond. And in this podcast we've got Mukul, who has joined us. He's got massive amounts of experience. Mukul Mohanty is willing to share some of his vast experience and his background. So let's just give you a bit of an update of who he is and so on, and then we're going to get to you directly from Mukul. So welcome, Mukul. Just hello and welcome to the show. Great
Thanks,
to see
Dudley,
you.
for having me around.
It's a big pleasure. So let's quickly give you a background. So Mukul supports sell-side raises from 10 to 100 million euros for IP-backed or asset-backed businesses that are technology-centric and looking for growth equity. Mukul has a strong background in leading early-stage and Series A funding, investment preparedness, and strategy, engaging with VCs, family offices, and private equity funds. He has a proven track record of building portfolios, successful exits, and management buyouts, and raising funds. In 2021, Mukul has secured almost $100 million across 4 ventures. He supported second-round funding for early-stage technology startups specializing in clean tech from 2017 to 2020. Mukul also successfully raised and exited 2 closed-end funds from Germany from 2012 to 2017. Mukul's buy-side experience includes 15 years of lead advisory and Big 4 PwC and EY in London, KPMG in Germany, and Andersen in India. And that's an excellent track record there, Mukul. So thank you very much for being on the show today. I want to just get going in terms of your background and where you're from, and give us a bit of an update of where does the story begin?
Well, the story actually begins in 1998 with as a grad scheme hire in Arthur Andersen. But I could split my career into 2 specific parts. The last 10 years has been more sell-side, focused on raising funds within the technology space. That I would say between 2012 and 2022. And before that, about 14 years within the Big 4, largely within transaction services and corporate finance. And so to start the story, I joined in Arthur Andersen in 1998 as a grad scheme, with a focus of qualifying as a chartered accountant. In the first few years, obviously, we're a part within Arthur Andersen Business Consulting Group. From there, I transitioned across to corporate finance in KPMG, Germany, between 2003 and 2006. Those were actually quite a great experience, because those were the days where Scandinavian private equities were investing in mainland Europe. It was the early days of project finance. It was the early days of renewable energy, lots of wind investment happening. And it was transitioning towards the big boom of 2008 in the private equity boom. And then from 2006 to 2008 onwards, as part of EY, when the private equity boom happened. And I think 2008 was the record year in terms of transactions. That's $500 billion in private equity deals. And my focus at that time, again, was industrial and a lot of private equity transactions, supporting on the sell side, interestingly. And those were the days we did very large VDD reports. We used to call them vendor due diligence reports. And that was preparing very big businesses for large exits. Did a number of those before transitioning towards the quieter period between 2009 and 2012, where a lot of us who were within corporate finance, transaction advisory side, moved into the restructuring space, looking out for all the transactions we did between 2006 and 2009. So again, within the M&A space, post-acquisition restructuring, again, private equity transactions, bank-owned assets in case where the equity had been wiped out, and also a lot of corporate transactions where big businesses were buying off assets of private equity. So in a way, been around the entire life cycle of a transaction in the first 14 years, from new assets to growth assets to large assets to restructuring of the large assets. So that was my career between 98 and 2012. Before 2012, I started focusing on the sell side aspect of transactions. I was part of a German closed-end fund. That was my first fundraise. We were at that point looking at providing finance, raising finance from the retail sector, and applying that across a new technology that was being based on non-euro denominated geographies that included Australia, UK, and Canada. Between 2016 and 2017, we attempted a management buyout of the residual assets at the end of the closed-end fund, and also tried to acquire the fund management company, which obviously went into competitive bidding. And between 2016 and now, I've been focused on fundraising in the new technology business space. I initially started within the impact and sustainability space, but gradually have diversified my interest across a different number of sectors, and I've been more of an opportunistic fundraiser rather than a sector-focused fundraiser, and looking at Series A and onwards, including project finance for new technology deployment. So it's a new kind of space, and then securing funding across the space from family offices, venture capital, and in certain cases bank debt where possible, and venture debt. So across the instrument. So that's really been my 24, 25 years of career, split between, like I said, early years within lead advisory and transaction services, where I got my rolled up my sleeves and understood the mechanics of M&A. And then after that, the 10 years in terms of then focusing on fundraising and sourcing capital for technology businesses. I can't hear you, Khalid.
That's a significant story there. So just for our listeners, the listeners' sake, you spoke a lot about your Series A, sort of more of a Series A based sort of focus in certain transactions. Just for our listeners, just give us a little bit of background. So what does that mean? What is a Series A as opposed to everything else that's out there?
I mean, that's a really, really good question, actually. And I constantly ask myself, what does Series A mean? Because, when we started doing Series A 10 years back, a Series A would be a 2 million raise. Now, a Series A, it could be a 20 million raise. So the magnitude has changed. Series A, from my perspective, where there is a startup has gone through a certain transition where there has been an angel investor, there has been some amount of follow-on investments thereon, and it's the first professional investment coming on board, right? This is not retail space, but probably possibly a VC or a CVC. And also the investor coming on at Series A is providing some value-add capabilities, right? And also validating the investments done from angel to pre-Series B. Now, that is my perception of it, because I find it very difficult to categorize Series A by quantum at this point. And a prime example of it is a business that I work with, which had a lead investor who had put in significant amount of capital, was almost about to tip across 50% with the founders. Friends and family had contributed additional capital at that point. The technology was what we could say TRL7, TRL8, which is a technology readiness level. And they just needed that amount of capital to tip it over to the point where commercial deployment would start. Right now, that was their Series A, and their Series A was 3.5 million euros. But there are different definitions of Series A. And now there's something called pre-Series A, and pre-Series B, and I'm sure it'll change. But the idea is, it's, I think, the first professional investment that comes in. And not discounting angels could be also professional investors, but the professional venture investment coming in could be categorized as Series A from my perspective. So yes, that is, again, like I said, a loose terminology that's it's being defined and redefined as venture space, and the startup space gets more streamlined.
Okay, so would you say that there are especially in the angel investment space, that where you're looking at Series A, would you say that angel investment has become more sophisticated over the last 10, 15 years? and at the time when it becomes more institutional at the Series A level, that you are potentially getting assets that are slightly better in terms of what the quality was maybe years ago? I mean, just give us a comparison on that.
Well, the whole startup space, Delhi, has changed significantly. And I can tell you it's changed year on year on year. So, I mean, it's an exponential change between what happened in 2018 versus 2020. So firstly, yes, the angel space has become smarter, more slicker. A lot of angels or high net worth individuals have started grouping their capabilities together and providing additional services to startup which they would normally not, right? So it's become more than a fund. And that's one bit. And the same has started happening from a family office's perspective. So yes, people are more aware of the opportunity. They understand the risk associated with the startups, that there's likelihood of failing. They understand there is a huge amount of support system that could help a startup be more successful. So whether, if you have a set of angels that have come together, which have in-house legal capability, in-house accounting capability, back office support systems, and if they extend that to a startup that they can then focus on technology, it becomes a more valuable startup. It improves the ability for it to be successful. So angels have recognized that it's got to be beyond capital, but also recognize that if they group in together with other angels, they have the ability to provide these incremental services that can, add on both value and the success, the possibility of success of the startup. So yes, it's a much more slicker, much more intelligent. It's a bit more intelligent environment. It's more an acceptable environment to be in from an investment perspective. And there is a clear understanding that there will be a hang-on to a professional investor at some point to that Series A. So there's a understanding that you need to prep that, I say asset or venture for that Series A, and there's an upside for the angels in terms of their own values. So absolutely, the angel environment is smarter, the VC environment has been smarter, and there's obviously then a growth equity environment which sets itself between the venture capital space and the private equity space. So it's kind of getting clear, definitions are getting clearer, and everybody is then leveraging of each other's capabilities to take the asset to the next level. So yeah, investment has become more streamlined in the venture space, or the high risk asset space.
Yeah, that's fascinating to me. It's got to be, I think, if you have a market, and I mean maybe this is a question for you. Would you say that the private equity and venture capital, even family offices, and angels and high net worth individuals, would you say that it's becoming more of a mature market? I think you mentioned pre our discussion that there are a few trends that you'd like to share, and from my impression is that there's been some let's call it maturity that's crept into the market, and maybe at the same time when you answer that, if you could sort of open up your crystal ball and say and give us what you think is going to happen going into the future.
Oh, I wish I had a crystal ball. But look, I think it's very important to look at the market, right? And I think we've been through a number of cycles in the M&A market, and the last boom cycle was 2008. Clearly, was 2008 private equity LBO market. But this market is, $1 trillion, just from a private equity buyout perspective, $1 trillion market. Right? And a third of those deals are in the technology space. Right? So a third of these assets have come through the process of being a startup, a venture, a growth asset to now a private equity asset, right? So one of the things is there's a huge availability of capital. That's very important, right? Without capital, there can't be any transaction. Without transactions, that will not, trip down to the highest risk asset, which is the venture asset. So the first important thing is there's a huge amount of capital involved. The second thing is that there is a better perception of risk, as I understand. In the good old days of 2008, we did a lot of projections, and we used to call it the hockey stick curve. And we had a lot of hockey stick curves on the revenue projections and the EBITDA projections. And hockey stick curves, yours is basically there's a sudden dip, and suddenly it goes, exponentially high, which is exponential high is the projection bit. And now but now we are actually have a different perception towards risk and and that allows us to be more aware of the fact that the risk we are taking has been built into the valuation in some senses. So that's the second bit of what I would say. The third thing is that there is a huge deal flow because the source of the deal flow, which is startups becoming ventures, becoming post-revenue businesses, becoming profitable businesses, and then being in a position to be either integrated into bigger corporates or or taken into the next level. So there's a huge deal flow that's happening also. Right?
Yes.
And that's because there is more awareness of the startup and the venture space, right? And that's how we can see today with the $1 trillion value in the buyout market, a third of that has come from the technology side. Clearly that has come into being in the last 10 to 15 years. So that's the third thing. And the final thing I think is that the types of deals have also changed. Right? You're looking at a lot more equity deals rather than debt equity deals, which used to be formerly the way to go, right? And that's because people have understood the upside on valuations. 10 years back, 2008, we never used the word unicorn. Now we use that very often because we can see the upside on taking that risk through valuations on valuations and the equity upside that they're making, right? And that's why the market has changed, but at the same time, the market has changed. At the same time, deal flow continues to be strong because the availability of assets and opportunities has increased exponentially, and to match that, the availability of capital has also increased exponentially. And I continue to see that happening for the next 2 to 3 years of course. I mean, at this point, with my little crystal ball, and I see that happening because we are not yet done with allocating the dry powder that there is in the market. There is record dry powder out there in the market. And that needs to find a home, right? And also, I see a very vibrant venture market where newer technologies are coming in, whether in the B2B space, B2C space, and so there is dry powder, and there is still a huge pipeline of assets that have to come to the market. So the next 2 or 3 years, I still see the potential for more transactions happening within the private equity sector and even in the venture space.
Yeah, I mean, that's a very interesting stats about the 1/3 being tech-based. What is your impression? And I'd like to lead at some stage into the 100 days and beyond, which is, what happens post acquisition, what happens post investment. But let's just delve quickly into what I think is something that I really want your input on, and that is the shift of traditional businesses that are becoming tech businesses. If you think about even I think the Macy's in the US where they're traditional department store, but they've turned their business into a tech-based business. So it now becomes what is the definition of a tech business? Because is it a brick and mortar business that has become, I'm going to use a crazy word called techified, have gone online, or is it a pure tech, as in, now you start venturing into apps and e-commerce and even down into the blockchains and AIs and all that kind of thing. So maybe just for the sake of our listeners, just to define what you mean by technology.
I mean, to be honest, if you look at Ocado, 10 years back, if you heard of Ocado, you think it's a delivery business, right? Now they have probably the most advanced robotics warehouses in Europe, right? And a fair bit of that technology is theirs, right? And I think businesses want to future-proof themselves, right? And this whole technology space is great, and they want to understand whether they would be relevant in 10 years' time as a brick-and-mortar business. If they did not adapt to changes. So this whole investment into technology is future-proofing themselves. That's the first thing. The second thing is also how markets change. And you talked about Macy's, and again, how retailers in the retail space are looking at online and thinking whether, brick and mortar would be relevant from 10 years from now, especially with the churn that's happening on the high street. So the first important thing is future-proofing themselves. And that's one of the trends that you see is obviously businesses having their own CVCs. A lot more businesses having their own CVCs because they want to look at investing into new technology that they can integrate into their own businesses. and that could allow them to be relevant 10 years from now.
Mm.
Right? So that's an interesting play that's happening. There's another interesting play that's happening is where certain businesses are looking at creating technology in-house. So they've got a kind of CVC, but they don't invest in these in ventures outside their own business, but they try to create pockets of ventures in their business that they can spin off to create value. Right? And that's quite an interesting play. Both of these are quite interesting plays. It shows the fact that businesses have recognized that that they have to understand what's happening in the technology space. They have to future-proof themselves, and also they see the fact that they could create value for themselves, whilst creating new ventures. Now, where does technology start? I think the critical point of technology, and I think is creating a product that's new to the market. Now, I'm going to step away from the words disruption or disruptive capabilities or whatever. That's new to the so creating a product that's new to the marketplace, right? Whether it facilitates the marketplace, so it could be logistics for technology within logistics or B2B, or it disrupts the marketplace in itself. If you're creating a product that's when we say if you're creating a product that's already there in the market, that's not technology, even if it's in the technology sphere, right? So if you have Uber and Bolt, they're basically saying they're basically focusing on the same technology, the same addressable market space of taxis, to simplify it. But that's not new technology. So what I always look at is what is the technology that comes in, what's the problem it solves, and if it solves the problem, what value it creates for itself and for the market. Right? And once you have a problem that it could solve that creates value for itself and the market, what's its route to revenue? Right? Who would its early adopters be? Right? What is its route to revenue? So how does it capture revenue in cash flow? Right? That's quite an interesting transition. That when I look at technology, I look at that space. Now, there's lots of new technologies that have created new markets, right? And I say new markets, but they could be existing markets, but they've kind of split the market. Women's health technology has become a very big market, and I think the ability to provide women's health separate from just generic health has become a completely different market, and that's led to a lot of new female founders providing specialist med tech, specialist health tech, specialist lifestyle tech to an existing demographic, but created themselves a separate demographic. That's technology. Right? So again, like I said, I understand technology as a product that is new, creates a new market for itself, and a new market for itself. But also, back to the first initial question on corporates. Corporates have recognized the need to be future-proof. Otherwise, their survivability would be in danger, and they would not know when they become redundant. Right? And that's one of the reasons they have to understand they have to absorb technology. Right? And they are actively looking at the market, either obviously at venture space, which is quite bold, but also at growth stage. So a lot of corporates are looking at new businesses that have now become post-revenue, post-profit, but haven't reached that point of scalability yet. And they're thinking, well, if we acquire this and absorb it and create a new market, this could be actually the main business, and what we did could be the minority share of our entire value chain. So this is a great time to be in the venture space, and from venture space, because again, back to saying an earlier argument, risk perceptions are changing. People understand that this is a fund, and there is 9 out of 10 chances it will fail. So people are entering into ventures with an open mind, and also with an open wallet, which does help. But also when corporates come into the space and understand, look, if that technology is something that works with our underlying product, and we're able to integrate it into our business and provide them capabilities, access to existing markets, access to existing customers, post-integration support, things that startups struggle with, we can create value, we can create synergistic values, and also, provide another product that could, at some point in a later stage, be our main product. So I think, again, like I said, technology is very hard to define. Hopefully I've done half a decent job. But But the most important point is that most corporates have decided that they cannot not be a technology company.
Yeah, so technology opens up multiple opportunities for multiple people, for multiple uses, whether it's going into an existing market or creating a brand new market or answering a new need in the market that's never been answered before, because it wasn't possible without technology, kind of thing. I want to ask you, this could be a tricky question, because what I've in my experience, I've noticed that we have a multiple sometimes direction change. So every time there's some kind of acquisition that takes place post merger, while you're going through that process, you obviously start in the beginning with an idea, strategic plan of what kind of synergies can we create out of the target that we're going for. What potentially sometimes happens is you have different types of integrations that happen. So you start off with a plan, and it could be a simple, let's call it a more of an arm's length type of acquisition where you literally get involved in the entity, but it runs pretty much on its own, under its own brand, and it continues operating, and you literally help and support that process all the way to the other side of the spectrum. And this is the tricky question, is just to understand where you sit in terms of your philosophy. Is sometimes the acquisitions in my mind swallow up a really good idea, and sometimes suffocate that idea because they've kept the idea for themselves. So, if you take some of the bigger players, the Apples and so on, I mean, they've bought technology to add into their own ecosystem. And that's pretty much the end of the growth story there for that idea or that technology. So I want to get, it's a tricky question. It's probably more subjective than anything else, but let me hear your opinion on that.
To be honest, I have gone through a reverse merger myself. Good old Alpha Andersen was integrated into Ernst & Young in India at some point. So I've been a victim of a merger in terms of, how two different cultures collide. So at the point of transaction, and I've seen many of these, you approach an acquisition from a certain perspective and an angle. You could approach it from the fact that this will be a standalone entity that will run its course and will be exited, or you could have the other end of thing where it will be entirely merged. Right? And I think that is a bit of investment banking and accounting approach to and operations approach to a transaction. It's I'm going to get married to you, and hopefully this will be a very happy marriage, right? But we haven't started living in together, in a simple sense. And I think post-acquisition and process, before when you say 100 days after the first acquisition, a lot of home tours, you get to know a lot more than you actually had bargained for because the acquisition has happened. That's the first part. The second part, I think, is even if you have industrial processes that get integrated, the most important bit people forget about is two managements need to integrate also. So there is a lot of soft integration that is required. There's always resistance to change. So I have seen acquisitions that have been acquired and then left alone, despite the fact that it was not part of the initial plan when the acquisition happened, and that's because there was a huge amount of pushback from the existing management. And obviously, nobody wants to disrupt management because you acquired a business because it has value in it, and obviously there is some value from the management. So, and I have seen acquisitions which have seen perfect merge integration within 100 days. And I think we discussed this earlier. Is when there's a corporate acquisition, an acquisition by a company of another company, and there is significant, and it's not through a bidding process, you have the ability to engage with the management and talk about how post-acquisition integration will take place, right? Because this is a discussion between two grown up corporates, and there is not a third party that would possibly gazump this transaction. You can actually prepare for that transaction to happen, and then have a post-integration process that allows the business to seamlessly integrate itself or have its post-acquisition plans carried out without too much disruption. The problem happens is when you are in a bidding process where you don't know till the very end, it's closed on the process, you don't know to the very end, you're the winning bidder. And then you have acquired business, and you've acquired a business and you're first focus is to beat other bidders and impress the management on what the post-acquisition would look like, because obviously the management have vested interest in staying on board post-acquisition. And then you have to realize the realities of the fact that you actually now in partnership or in ownership of a separate corporate. And then obviously the integration process takes much longer. Right? So the first thing is, from my perspective, as I've learned, is when a business approaches an acquisition, it has to have a certain plan ready to execute post-acquisition integration. Right? And that may not be a robust plan, especially if it may not be a defined plan, but a skeleton, a rough draft of what will happen needs to be prepared. But if you are not in a bidding process, there is a lot more opportunity to understand how you would manage yourself post acquisition, and you have also get the management of the target on board as soon as possible with what would happen post management. And it's like it helps because in one of the businesses that I looked at, I was very surprised that it's $200 million acquisition. The parent company would be worth $1 billion, and the management of the target actually became the management of the parent business, and that was pre-agreed prior to the transaction, right? And roles were defined. There was commonality. There was understanding of where synergies could be achieved, where value could be achieved, and they were also understanding about which of the existing management team would not continue, and they were explained and they were given a fairly nice golden parachute. So they had worked it out, and today, if you look at that business, you could not make out that they went through that acquisition. It was perfectly streamlined. It was done in a very mature and sensible way, and was, despite it being in the industrial products sector, the soft decision making and integration took place before the business integration took place. So when the management teams were integrated, the rest of the synergy plans, the rest of the operational plans were executed within the plan of 18 months. So that's a very good example of it. In some other cases, like where I've seen where a German company bid for a very large consumer business in the UK, and where was worth a $1.1 billion deal, and the transaction happened at the very last day. But with 12 hours, there were 4 bidders, and in the 12th hour, literally at the 12th hour, one knew that he was the winner. They were quite careful about it. They had spent about 18 months with the business, with the former parent kind of merged in. They did a separation over a period of 18 months. They left the business for another 18 months as a standalone business, let it stand on its feet, understand its own identity, and then merged it. Right? And I think that was a very sensible approach. And they understood for about a period of 36 months, that's 3 years, that value could not be generated because this transition had to happen. And in that case, it was about value preservation and capability preservation. Right? So that's again a part of the a part of the process that needs to be understood and managed. And again, it comes from top level management, both from the target company and from the buyer. In private equity, I've noticed there's when you do a transaction, there's an urgency to rip it out and take it apart. Not rip it out and take it apart, but separate it as soon as possible. Right? Because in private equity, there is a fixed period before you do an exit or do a turnaround or do a value add. And obviously, it's run by financially focused executives or principals and partners who work on a return on investment from their investors. Right? So a private equity transaction can be an entertaining transaction, especially if it's a carve out. That's one. Or if there is a complete buyout. That's number 2, because the focus changes significantly. If you have a corporate owner, corporate shareholders, and you have private equity owners, your perspective changes quite quickly. Again, my experiences have been that I have seen things where it has not worked out. It has not worked out because the private equity principals have oversold what they could do with the business, which was operationally not possible. So there's a mismatch on how you do the hockey stick, while the management would not like to buy themselves into a hockey stick. They like to keep the targets low and then overachieve more than the set targets. But again, these are all anecdotal. Right? Lots of new private equity teams have very good ops teams. They're very sector focused, so they can bring these ops teams into the sector, into these sectors. And that's been happening actually for more than 10 years. It's more since 2008 that they realize this can't be a complete financial transaction. There has to be a value add. And the value add has to be with a team that has significant strategic capabilities, significant ops capabilities, cost saving capabilities, commercial capabilities. So they bring in a third party team that's separate from the transaction team. So that has also happened in the private equity space. Again, back to what you asked about, like I said, there's no hard and fast rule. Every transaction is different. People do a lot of work on post-integration merger, post-integration support, and it doesn't work out. See, some people wing it, and it goes pretty well, and it's all dependent on what the quality of management at the top level is and how much buy-in you had from the target.
That's it's a brilliant answer. Thank you for that. I mean, that's given a really good view. So it's a pairing thing, and I imagine that there's some level of introspection that has to happen from a buyer side or an investor point of view to say, who are we? What is our culture, and what is our sort of view of the world, and see if what we're targeting to invest in is a bit of a match. So there's more connection from a people and a culture and that sort of point of view up front. And I'm not sure. What is your experience? Do people do a little bit more self-evaluation before acquisitions, or do they purely, focus everything on targets? Is it more about what the target is like?
2008, 2009 onwards, we saw a lot of assets in which the equity had completely been wiped out and banks were in control of the assets. Now, these are operating businesses that employ thousands of people. Right? And suddenly, the creditors have become, business owners, right? And that I saw created a lot of value destruction. And that was because suddenly banks who have, their focus is on the debt that they've provided to the business, not only, are now responsible for this business and responsible to make sure that there is enough cash coming in for at least the interest payment, if not capital repayment. So I think that was a quite good example of where you need buy-in from the target and targets management, and you need to have an understanding of what you're getting yourself into. Like all, from private equity's perspective, buying a business is like buying a yacht. The happiest day is when you buy it and when you sell it. Right? In between, you have to provide value to it, right? And otherwise, you're just paying cash to buy a cash flow. From a corporate's perspective, it becomes more complicated because it's marriage, right? Even or an adoption, whichever ways you look at it, right? And then it becomes how do you management is interesting because it means that you have responsibilities towards the corporate that you've acquired, and adoption is also that you have the responsibility to provide guidance and support and manage their expectations with your own objectives, right? So 2009 and 2010 were interesting because I saw a lot of businesses which I thought were fantastic businesses and have always been fantastic businesses suddenly lose shareholders and be run by banks who are traditionally not. Their job is to provide debt, not to run businesses. Right? So I think it was an interesting eye opener from my perspective, and it also showed that how much pressure it put on the management to create new revenue streams, new cost-cutting capabilities, new, they were under pressure to raise the top line and then reduce costs. So banks effectively, without knowingly or unknowingly, were asset stripping a business. But what it was doing was business was not going to be sustainable in 4 years' time, and their ability to pay interest reduced, their creditworthiness reduced, their ability to compete within the market reduced, and it wasn't. It didn't help anybody's goal. So that's an important learning, and that's where I come back to. Is a corporate shareholder or owner, whether it be a venture, a majority shareholder, whether it be a private equity, a growth equity, whether it be a corporate, whether it be an individual, has certain responsibilities as a shareholder towards the business to make sure that it provides support, management the adequate support to grow.
Yeah, I've been part of a number of restructures and so on, and often, or even when there's let's call it, the business is starting to look like it's getting into liquidity problems, and the bank steps in and they send in these special teams, which you may have heard about, rescue, yeah. And they literally start to strangle the entity further, as opposed to add much value, because everyone starts getting nervous and so on and so forth. So it's an interesting dynamic when you have almost the wrong fit and wrong philosophy. Not wrong, but it's misaligned for when you're entering an entity. So I want to know more about yourself, Mukul, around your philosophy around. Once let's go through a process. What is your philosophy? Things like, is hands-on better than hands-off? Is it, do you feel more comfortable in letting team operators do their own thing? Do you prefer a little bit more direction, but hands-on? Where are you at in terms of a deal cycle, and even up to exit? Because you have been part of a few exits, and just to understand sort of that whole sort of start, middle, and end when you've left, just go through that and some of your personal sort of feelings around it.
So, I mean, when I look at ventures these days, when ventures come across, when I meet founders, and they say, we would like to raise capital, we want to raise capital, and I was like, my first approach to that is to understand what the business is about, because sometimes you can provide value and raise capital. And a prime example is a business that reached out to me, that's a B2C business, SaaS, and they wanted to raise capital because they wanted to, they basically facilitated integration between loyalty programs and payment programs. Right? And my first focus to them, my first, they wanted to raise about a few million euros. And my thinking was, wait, hold on for a second. Who are your customers? What's your target customer? I said, why don't I introduce you to X, who could be a customer and an investor? So the approach is slightly different. The approach is to create value by providing a solution and capital simultaneously. Right? Now, from my experiences, it's very, very difficult once you do an acquisition to be hands-on as a private equity professional, because at the end of the day, you have to trust the management. And if there is a problem with the management, at the very inception, you need to replace the management. And that could be a problem with the management. The management just got lethargic, the business is going all right, they don't really care, but it has huge potential. So if that's the problem, you've got to change, you've got to address that problem at the very onset. Right? The fact is, we are financial wizards, but we don't understand the business very well. And that's very important to recognize. We are very good in providing advice and support from the outside, because we are looking from the outside, which is helpful for a business, because they would need an honest opinion and honest feedback on how the business is going. But if you're rolling up your sleeves and you're in the business on a day-to-day basis as a private equity investor, or even as a corporate investor, something has gone wrong seriously. And that's very important. You have to trust your management. Again, as a venture capital investor, if a VC has taken on management responsibilities, and I have seen that happen on startups, that is a red light, an indicator something has gone wrong, has seriously gone wrong. That's very important. So if you're a VC and you're hands-on with and you have to take quasi-management roles in businesses, because the management's not up to scratch, your principals are being sucked in, you're doing bi-weekly meetings or tri-weekly meetings with the asset, something has gone wrong, right? And the first thing you need to do is provide capabilities in-house, because you need to have an arm's length away from your venture, because so that you can make a very brutal decision whether to further invest or to come.
Yeah, I want to ask you a little bit more about that, because I imagine, I spoke to someone last week, and they were saying that the more you get involved, it's almost a signal to management saying, you're not doing a good job. So the more you get calls and meetings and questions, the more you must realize that someone's not trusting that you're doing your job. So that was that just reflects pretty much what you said.
If you're a principal and hands-on with venture, it's a problem because you will have 15, 16 portfolio businesses, right? If you're going to do 3 calls with one business, how much time are you going to dedicate on the remaining 14?
Well, that's the other thing is then you start to neglect the other parts of where you should be focusing on. So that is a very interesting concept. The other thing, and maybe just again from a personal point of view, if you've ever had to do sort of rolling up the sleeves and getting involved a little bit, don't you think that sometimes that would skew from an investor's point of view your sentimental or your emotional connection to the business being a success? You tend to, the more you work in it, the more sort of emotionally connected you become to the outcome. Would you agree with that? Or maybe you can expand on that?
No, absolutely. That's why I said you've got to be in a position to cull, right? And if the asset isn't working or isn't performing, then the question is, do you want to, especially at the venture capital stage, do you want to do another round of funding? Do you want to actually put that asset out into the market and push that from push that asset for other funders when they know it's not going particularly well? So that's an important part of it, that you have to keep certain distance from the venture so that you can have an objective view of how the venture is operating. Right? It's not a problem to roll your sleeves up and get your hands get yourself involved with the asset, but that could be a secondment by a team member for a 4-month period, as for example as a CFO, right? And that's so that the financial capabilities are streamlined, or getting a commercial director on board so the revenue base is consolidated. Those kind of secondments work very well, but you can't be, you have to, the bird has to flee the nest, and you have to make sure that the venture is a standalone venture in its own self. Now that we're again talking about financial investors and assets, and in a corporate environment, you could be taken completely differently, where you always have troubleshooting. You always have to do troubleshooting, or you always have to provide additional support. There's a lot more complexities because, again, like I said, it's a marriage/adoption rather than more of a financial contractual relationship on a financial transaction. So, but you're right. I firmly believe you have to keep an arm's length from the venture so that you can have an objective view and support it as and when it needs, but step out after that support is provided.
There's one last extension I want to have on that before we move into the next topic, and that is when the target acquisition, you do Series A, so that they'll slowly be formalizing, they'll be getting a bit more traction, they'll be having a few customers, etc. There's really 2 parts of this question. The one is that it appears to me in tech businesses the time to revenue is a lot shorter. If you take Microsoft, I think it took them 40 years to reach a certain market cap, where now it's literally. I went to an event the other day, and they've reached $1 billion in something like 9 months, and it's like, how do you do that? I mean, and that speed at which things go. So that's the one angle where they're clamoring over themselves to get skills and so on and so forth. And then you've got on the other side, where you've got more, let's call it family-based business. So you've got a dynamic difference. So you got a business that's more nepotistic. They have the father, the son, the mother, the daughter, the cousin, the uncle, the aunt, everybody in the business because they can't find people that they can trust, kind of thing. And on the other side, you've got a whole bunch of young people, inexperienced. They're just piling on people just to fill seats because they're growing at this rapid rate. Give me a bit of your perspective around that.
The startups, recruiting in startups is a serious issue, right? Because actually, firstly, you're a small team. You have a certain ethos. You have a certain culture, and you want to be driven. You have certain objectives, and it is a more riskier environment to work in rather than an established company because it may not last. So startup cultures are very different. There's a heavy founder involvement. It may not be a clear hierarchy, but more flat hierarchy. But it's something that excites people these days. And so a lot of people like that environment, like that uncertainty. Also have understood that in some ways it's better to be paid less and have more, more equity, ESOPs and other type of value-based payments, because they can see themselves have be the first 20 employees and possibly make themselves a millionaire. So that environment is great. It's a great environment, and it suits some sort of people, right? But also, you are right. I used to live in Germany, and Germany is very famous for family-run businesses, the Mittelstand, and that also works quite well in terms of I don't see anything wrong in family businesses. Also, because if you look at certain family businesses, and even in India, the next generation has actually done better than the first generation, because the first generation has provided the next generation with the capabilities, the education, the skill sets to actually take the next step in the business, right? So both work. The thing with startups and ventures, it's a dynamic environment. It's an unstable environment. So it's very exciting. There's a lot of adrenaline. There's a lot of creativity. It's more collaborative. It's not traditional hierarchy, but also it's driven by the founder. The culture is evolving. It's also very fast-paced and high-stress environment, because again, you are working in an environment where burn rates and cash rates matter. And the founder could be out of money, and they could, there's a possibility in the next 6 months there's not enough cash in the business to pay salary. So there is a value to that. There is a reason why a lot of I would say younger folks are attracted to startups, but also people in their mid-40s, who have paid off their mortgages, have a bit of kitty left, have decided that actually I don't want to sit on a desk and report to a boss for the next 20 years of my life. I have a little bit of money. I want to invest it, and I want to create value for myself. Right. So it's a mixture of people in their in their 40s and the 50s. And I think James Dyson was first successful at 47. Now that's a really good example. So
yes.
So it's a certain set of people that congregate. I would say gender-free, race-free, and age-free that congregate in an environment that's in a venture environment, right? And at this point, I can't think of a better place to be in, because firstly, the market is receptive towards such ventures. Secondly, there is capital being allocated for that venture. Thirdly, there's a huge number of success stories, and I think we focus on the success stories, less on the failures. And obviously, you don't go to a casino table and say, well, there's 31 numbers to lose. I'm going to think about one number or whatever number that's going to come. So that's a great environment to be in. And a lot of family businesses, and I'm coming from India, where family business, a lot of second generation, third generation are actually out getting experience in these environments before they come back, because they see the flexibility, they see the reaction time that these startups have, they see the creativity these startups have, and they come back and say, actually, we should have some of these. Right? And that's refreshing old family businesses with new ideas.
I love that. I love that a lot. So give us anything else that you think is a golden nugget, that's a takeaway for the listeners, something that they say, yeah, okay, well that's a pretty good thing. I mean, have you got something, some golden nugget to share, or even a few?
I don't know. I absolutely, I can give you some steel nuggets, not getting good ones. I think the critical point is, if you are in this space, you're constantly learning. You'll never see a deal. You'll never see two identical deals. You'll never see two identical transactions. You'll never not learn from, every time you see a new technology, you will learn new things, right? And every time you see a new, even from a transaction to a new term sheet, new SPA, new business plan, everything's a learn. So if you are somebody who's, I'm quite ADHD. So if you are somebody who likes to have new things coming across your way, this is a great space to be. And I think I know, I come from a school where a couple of my friends are absolutely private equity wizards and top of the game, New York Times articles happening about them. And when I sit with them, they're trying to suck out information from me, what I did on my last deal. And I was like, but you guys are private equity wizards. You know everything, You are the top punchers. And they're like, well, no, we're not, because I haven't, I want to understand what's happening on that transaction, on these, on deals of this size, on minority transactions, on what's happening in the medtech space. So if you're in this space, if you're constantly learning, and if you can constantly learn, you do well, right? So it's about learning and persistent, you know. And I think that's the only thing I can say. And I think I actually don't know enough. Right? I genuinely don't know enough. You know, I would not call myself as the smartest guy in the room by a mile, which is a good thing. That means I'm in the right room. But like I said, the M&A, the transaction, the venture space, the startup market, all of this is going to evolve, and it's like a prism. Different things will happen. Nothing that has been repeated in the past will be repeated again. So if you're a lifetime learner, this is a great place to be.
That's marvelous. That's excellent. Thank you very much for that. I want to ask, and I see how passionate and enthusiastic you are about your topic and your career and all that, and it's wonderful to watch and experience a conversation with you, Mukul. I'm very keen to know. Mukul is a young boy, growing up thinking, I don't know, playing, doing what you would normally do at a young age. And at what point, I mean, what did you want to become? And at what point did you realize that this is the thing? So I'm really, really interested to hear what that is.
When I was a kid, when I was in 10th grade, I wasn't very academically bright. And then somebody said, you should become a chartered accountant. I said, what's a chartered accountant? It's like, don't worry. Except a chartered accountant always makes money. I said, that's a good idea, you know. So I really, really strange. So, you know, it stuck in my head, funnily. And then I did spectacularly well in my A levels, GCSE, to the 12th grade. To the point that I think my family turned up at school thinking I was lying about my grades. You know, 7, 8 double stars, or something quite ludicrous. I was also, you know. So I went to a college that actually was a great training ground for chartered accountants in the future. And then I got picked up by Arthur Andersen. So, you know, so I didn't actually think about it like that, but it just kind of fell into place. I have to say, when I moved into the transaction space, it took me a while to enjoy it, right? And so one of the things I've learned in life is that you will reinvent yourself many a times. And there is nothing wrong with it. We will have long careers. We will be working for a very long time, largely because we live longer, right? And so be bold to reinvent yourself. So I started with Arthur Andersen, did consulting. I moved to transaction advisory. And then from transaction advisory, I moved to lead advisory and sell side, right? It took me a while to find what I wanted to do. And the reason I think, I was talking to an old former partner of mine in PwC, and he said, Mukul, you are very good at structuring transactions. You should focus on that. You should be the tip of the spear. And I said, and his perspective was that because the transaction is done and you can't see what's past the transaction, you get bored. You are a bit like, well, I put so much effort. It's done, and they, you know, it's like a priest. We help them get married. They go away. They never call us back, right? And so that's the thing. I'm quite. I became a chartered accountant on Women Fancy, but I never did anything related to accountancy. But it's helped me get into lead advisory. It has helped me have a lot of experience, and some of this experience just comes at your back when you come to a situation where you don't know what to do. You say, I've been here before, right? In 2007, I was here before, and this is what I need to do. And then, like I said, the last 10 years have been excellent from sell side perspective, because now I feel like I'm in the tip of the spear where I'm able to communicate to the investor what the value of the product is, whatever that product might be, right? Whether it be a venture, whether it be a fund of fund, whether it be a transaction. So the idea of, you know, articulating value, something that I'm very, you know, that I'm keen on, and that's what I do. So, like I said, whatever you start off with, you will reinvent yourself many a times in your career. Just don't stop reinventing yourself, you know, and everything's not feedback.
So leading from there, then if you had to advise somebody that's thinking about entering this world that you're in, what advice would you give them? Because this whole reinvention thing is very, very important, and I think it's happening more and more for a lot of people in their careers. And no matter what age you are, I'm guessing, you know, but let's say no matter where you're at, and you think, oh, M&A looks like a good thing, or, you know, post merger integration, it looks like a good thing, or even just sitting sell side, buy side, or I'm in a company already, how do I put my hand up and say, hey, I want to be part of the internal M&A team or internal integration team? What advice would you give them?
I think reach out to people. I think that's the best thing. That's the thing. When Arthur Andersen, we were taught two things. This is, when we were first year analysts, we were taught that there is no question that's stupid. If you don't understand, just ask. Just put your hands up. There's nothing that you will never be judged on a question. In second year, we were taught that when first years ask a question, no work that you do is important enough not to answer that question. Right? So I think that's the critical point. Is I believe that if you seek guidance, ask people, right? And some people may not help you, some people may help you, but count on people that help you, and that's how you actually break into a sphere. Reach out, be enthusiastic, and be motivated, and be wanting to learn. Right? And that's the critical point. And that's one of the reasons that most of my opportunities have come from people, from references. Some people said, "Oh, we know Mukul very well. Mukul's done this before." And Mukul's, he'll be honest enough to tell you what he knows and what he doesn't know. Right? So, don't be afraid and just reach out. And that's a good point. And read, right? And read as much as you can. But talking to people is much better is very good also, because experiences are very different from literature.
And we're nearing the end of the conversation, and it's been a fascinating conversation. Mukul, I want to ask sort of, what next? I mean, what is your plan for the rest of your career, and what does it look like when you're done? I mean, what is that sort of milestone or big thing you're working towards, or if not, I mean, where are you going? I mean, let's say, what does the future look like for you?
Well, the future, it looks like hopefully being within the startup and venture space, supporting ventures raise capital, supporting new technology businesses becoming the next unicorns. I wouldn't say unicorns, but the next success story, right? And so I see myself in the venture space for the next 5 years, and at least the next 5 or 10 years. And I see no end point, because I think I would be, I think I'm too relentless and too restless to stop. So I think that's the bit. I see myself within what I do, because I thoroughly enjoy what I do at the moment. Looking at new opportunities, matching new opportunities to capital, creating capital for people who find new opportunities. So I love the place where I am in. I get to meet more people, learn more things, and hopefully I can continue doing that till I drop dead. And it's not all philanthropic. Hopefully make some money on the way.
I mean, it's wonderful, because I'm sure there are many people just as passionate about what they do, but there are also many people out there that got themselves stuck in a place that they're not enjoying anymore, and they're not finding that inspiration and that pleasure. It appears to me that you wake up every day excited, happy. You seem to be very driven and directed, and you love your learning and so on. And I mean, that's massively inspirational. I think for anybody listening to the show, I'm hoping that they can take that enthusiasm for life, as well as all the great information you've shared today. So I don't know if you had a finishing comment on that, and then I want to wrap up.
Hopefully I was coherent enough, because as you know, today was a funny day. It's snowing and it's quite nippy today, but hopefully I was coherent enough, and I was trying to give you as much without actually sharing actual deals, which obviously but hopefully people can get an insight into what my career has been and what I've been doing, and and if anybody wants to reach out, I'm always happy to speak to people. My door is always open. I give a lot of pro bono advices to a lot of ventures, a lot of startups, and that's because I think they're good people who put their lives on the line to make something great, something that could be the next big thing. So I have an immense amount of respect for that.
Lovely. Okay, so what we'll do, Mukul, is we're going to share your links to various things, share your information, and so whoever wants to contact you, they obviously welcome to, and I wish you absolutely everything of the best going forward. And I really would like to invite you back on the show in sometime in the future, and see how you're getting along, and what what's happened next in your life.
Brilliant. Sounds great. I'll be delighted to come back. Thanks for the opportunity.
Yeah, thank you very much. Great. Okay, so
Hi everybody, this is Dudley again, and if you need help with a future or existing post-merger integration, I want to invite you to arrange a free, no-obligation meeting with us. During the meeting, we'll find out exactly what you need, what your challenges are, and we'll explain how our unique PMI slipstream method can help you. Simply call us or visit mergerintegration.co.uk. That's mergerintegration.co.uk, or come to our website, skillfulpursuit.com.